By late February, the outlook for the American housing market was bright. Prospective buyers were preparing for a robust spring season, encouraged by a steady decline in borrowing costs. That trend reached a milestone on February 27th. For the first time in months, the average 30-year fixed-rate mortgage touched 5.99%, meeting a long-awaited psychological threshold for many buyers. However, the market erased those gains almost immediately. Within weeks, the average 30-year rate climbed back to 6.55%, a six-month high that stalled the spring momentum. Local market conditions remained stable during this period. Neither the domestic housing supply nor national real estate policies shifted enough to trigger a move of this magnitude. To identify the source of this volatility, we have to look past the American suburbs and focus on global supply routes. The mortgage market is currently reacting to a major disruption in the global crude oil trade. Predicting the cost of a local home loan now requires tracing the complex economic journey of a single barrel of overseas oil. The pressure begins with the Iranian conflict in the Middle East. This regional tension has become the primary catalyst threatening global energy stability. As the threat of supply chain disruption grows, the market prices in the risk, causing the cost of crude oil to climb. This spike in raw material costs translates into immediate financial pressure for domestic consumers, manifesting as gasoline prices exceeding $7 a gallon. In effect, this overseas conflict imposes a sudden, unpredictable tax on the global energy sector. This creates a direct obstacle for the Federal Reserve. The central bank is currently focused on cooling the economy to meet a strict 2% core inflation objective. High fuel prices increase the cost of transporting everything from consumer electronics to groceries. We see the result in basic food inflation, where a single package of bacon now reaches nearly $7. On March 18th, the Federal Reserve responded to these rising costs by freezing the federal funds rate between 3.50% and 3.75%, choosing to pause rather than initiate the expected cuts. With the central bank paralyzed by oil-driven inflation, the financial markets have begun to price in their own defensive adjustments. The 10-year Treasury yield acts as a barometer for this inflation fear. By March 20th, it surged to a six-month high of 4.39%. Lenders use this Treasury yield as a baseline for housing loans. They add a consistent 2 to 3 percentage point spread on top of the yield to account for risk and profit. When we add that lender spread, the math leads directly to the 6.55% rate currently stalling the market. Ultimately, the American homebuyer is paying a risk premium for geopolitical instability in the Middle East. The question now is whether this 6.55% rate is a temporary spike or a new baseline for the housing market. Market analysts are focused on the persistence principle. The primary concern is the duration of this energy price increase. Temporary price swings cause short-term volatility, but sustained energy costs can pull Treasury yields and mortgage rates into a long-term upward climb. The immediate future of the housing market depends on whether the energy sector's fever breaks or if these high costs begin to embed themselves across the entire economy. Prospective homebuyers must look beyond local real estate listings to understand their financial future. The upcoming PCE and CPI reports are the critical indicators to watch. These inflation figures will signal whether the Federal Reserve can finally begin lowering rates. These reports will determine if the Fed must maintain its current strategy to protect employment or pivot to combat rising prices. Signing a mortgage has evolved into a high-stakes macro bet on the stability of global geopolitics.